Thanks for joining us. So on this interview here right now, we have Nawan Bud from Purpose Investments. I'm very excited to talk to you, Nawan, because we're going to be talking about the two brand new covered call crypto ETFs. So just for my audience, if you wouldn't mind introducing yourself and what you do at Purpose Investments.
Yeah, thanks, Adrian, and thanks for having us on the show. It's great to get a slightly different exposure for our ETFs out there. So Nawan, but I've been at Purpose Investments for about 8 years now. I'm with the portfolio management team. I'm a portfolio manager at Purpose Investments, taking a look at some of our more risk-on strategies, such as cannabis, crypto, and then also asset allocation as a whole.
Okay, perfect. Thanks for doing this. Really appreciate it. So let's get into it right away. What made you guys come up with the idea of basically creating these covered call crypto ETFs, which are pretty much, correct me if I'm wrong here, one of a kind, really the first of its kind?
Yeah, absolutely. So, covered calls have been around for a while. We've had our fair share of experience with covered calls. It's a good strategy. It makes sense for many different asset classes for different reasons. Once we really figured out how to get crypto exposure in a regulated entity, that was step number one. Once we figured that out, then from there it was just, how do you provide a slightly risk-adjusted exposure or an enhanced income exposure on top of something that's very volatile, very nascent, is still trying to find its way, and appeal to an investor that might be put off by some of the volatility within the asset class itself. So, given our sort of experience in covered calls and derivatives, we thought it'd be great to sort of marry those two worlds. And so far, it's been actually, a very interesting place to traverse. Because combining the old with the new, it's combining traditional covered call strategies with the brand new world of crypto. It's been very interesting, and I think fairly successful.
Yeah, very unique, very unique. I really like it. And as you know, my audience, my channel is all about income investing. So these two crypto or ETFs are really perfect in that regard. So touching on that subject, in your opinion, for who do you think these two ETFs, these two crypto covered call ETFs are really designed for? What kind of investor?
Yeah, so we're really looking to target investors with these new ETFs. Investors who have an active take or an active or emerging take as to how they want to invest their money. Investors who are more forward-looking, but also want a balance between that forward-looking and traditional asset classes or traditional strategies, such as covered calls. So we really think, this is made for retail investors who wouldn't typically have access to this strategy. So they wouldn't typically have access to go write covered calls on a name in any sort of size, and wouldn't be able to sort of throw their weight around. So what we want to do is we want to give them really an exposure to this strategy that's being implemented by others on a much larger scale in the actual underlying. But when it comes to the regulated market entities, we want to really go for retail investors that don't really have exposure to these asset classes. So the current funds are available to anybody who can access Canadian exchanges. So as long as you have a direct invest account, you should be able to access any one of the series of our Ethereum or our Bitcoin yield product.
Yeah, that's perfect. And you see it right there on the website, right? It's TFSA eligible, RRSP eligible. So it basically trades like an ordinary regulated ETF. So this is not like anything crazy out of the box. This is really, it's listed on the Canadian exchange. You could buy and sell it as you would a normal ETF. So very, very easy, all-in-one covered call solution. So that's really cool. In terms of cryptocurrency, I don't want to touch too much on this. I don't want it to be about crypto specifically, but do you feel that, cryptocurrencies in general, especially Bitcoin and Ether, which are the two biggest ones right now, will they become a more stable and accepted asset class in your opinion?
So I think we're starting to see this happen already. Bitcoin and Ether and cryptocurrencies in general are an emerging asset class. They're sort of a look into our future and see how technology can enable our future. They were sort of like, and we're seeing increased adoption sort of across the spectrum. We're seeing increased adoption for retail. We're seeing increased adoption for corporates. You hear more and more stories about remittances now being cryptocurrency based. So if somebody wants to transfer money from Canada, for instance, to Mexico or to anywhere, in the world, cryptocurrencies offer a very safe as well as efficient way to transfer those monies. So, there's many different applications of both Ether and Bitcoin, slightly different applications. They are, fundamentally different cryptocurrencies.
Right.
But nonetheless, we're seeing a very mass adoption going on right now. We might not be quite there yet, but I'm very interested to see in 3 to 5 years' time what this ends up being.
Yeah, yeah. And the two key words that I heard you say is technology and emerging, right? So when something is emerging, there's going to be a lot of talk, a lot of chatter, a lot of swings, a lot of volatility. And this is expected with cryptocurrencies because, like you said, it's fairly new. And you also said it's a technology. And I've been, because of these two new ETFs, I haven't really been looking into crypto that much, but I've noticed, and from what I read, the crypto prices, they kind of are associated somewhat to technology stocks. Correct me if I'm wrong here. Is that correlation an accurate one?
Yes, so the correlation is accurate, but I think it's important to get into the causation of why these two are correlated. Really, the way to think about it is when money becomes cheaper, people, valuations of riskier items gets higher because of asset allocation and money flows. So those are the two general ways to sort of think about this asset class. As we are seeing, we've gone through a period of monetary and fiscal expansion for the past 2 years. There's been a lot of money that's been thrown into risk-on asset classes, more speculative asset classes, and therefore we've seen technology, but more specifically, less profitable technology stocks actually, shoot up over the past 2 years. Right. And so has cryptocurrency, just because, again, the speculative nature of it is still very much there. So because of that, we think there is a correlation there, but it's important to take a look at the causation. And the causation is also what's causing the correlation on the downside as the market prices in a Federal Reserve, which is looking to hike rates, becomes more expensive to deploy money. It becomes, the risk reward of more speculative or risk on asset classes gets a little bit, or gets a little less attractive. And that's why we're seeing this money flow out of cryptocurrencies and money flow out of low profitable tech companies and back into safer stuff. So, over the long term, there will be ebbs and flows in this. There will be correlations in this, but it's really the fundamentals that you have to take a look at, because we're not trying to invest for the next, 6 months. This is passive investing. This is, how do you gain long-term value? How do you, get a stable portfolio, long-term value, get a yield out of it? So we really want to be taking a look at that, the 3 to 5 to 10 year time ranges and evaluate these the fundamentals of the underlying when we're taking a look at investing in cryptocurrencies.
Yeah, I have the same general sense or strategy when it comes to investing. I always tell my audience, you should be in it for the long term, not 6 months, not 3 months. We're not traders, short-term traders. We're long-term investors. So that's perfect. I completely agree with your assessment there. So getting back to the two yield ETFs here, as we know, covered call strategy, there's really two important aspects or two important factors. There's the coverage. So you're writing covered calls on how much of the portfolio, what percentage, and also the moneyness of the options. Are they out of the money? Are they at the money? So in terms of for purpose investments option strategy with these two ETFs, what's the covered call option strategy? Is it set in stone? Like, for example, BMO has a covered call strategy that's set in stone, right? They do it on 50% of the portfolio, always out of the money. So are you guys, do you also have a set in stone covered call policy, or is it really a dynamic approach that's reviewed every month, let's say?
Yeah, so strict rules make more sense when you are in a stable asset class that really, you have long-term expectations, which are very stable. For us, taking a look at how dynamic this asset class is, we have to be dynamic as to how we, make decisions in terms of coverage, moneyness. And then the third factor, which is also important, is the implied volatility of the underlying asset class and where it trades. So as far as the coverage goes, we actually have a fair range with which we can play. So the fund can be overwritten, either of the fund can be overwritten anywhere between 10 to 50% of the portfolio's NAV at any point in time. The way we decide how much to override is a mix of fundamental and technical analysis. Fundamental analysis is great, but when it comes to Bitcoin, when it comes to Ethereum, fundamental analysis actually flows through very weakly to pricing models. So what we rely on a little bit more is technical models. And what we do on a technical basis is identify areas where we think the two cryptocurrencies could be overbought and or oversold, and then increase or decrease our coverage accordingly. So for instance, if we believe cryptocurrencies are highly overbought, we will overwrite calls as much as we can, up to 50% of the fund's NAV. If we believe cryptocurrencies are oversold, like for example, where we think we are right now with Bitcoin roughly at 38,000, we think this is where you stay a little bit on the 10 to 15% side on how much you overwrite the fund, and because you still want to give a full sort of exposure if Bitcoin takes off here. So we're trying to be a little bit more thoughtful about how we sort of implement the coverage of how much we overwrite. And as far as MoneyNest goes, MoneyNest has similar sort of we have a similar look to MoneyNest. So if we think Bitcoin is very much overbought, we will try and write closer to the money so that we can get a little bit more option premium. And where we're in this, where we are right now, again with Bitcoin, reference 38,000, we will try and write further out of the money, maybe generate a little less yield. But what we don't want to do is increase the risk of being called out in the fund and missing out on the upside. So there's a little balance that we're trying to play at all times over here. Technical analysis is very important for us and what we do. And with technical analysis, if you're right more than half the time, then we think we can give the investors a fairly good experience.
Yeah, no, that makes perfect sense. And in my opinion, that's really the way to go. I wouldn't want it to be set in stone for anything volatile like a cryptocurrency. So basically what you're saying, correct me if I'm wrong, if you feel that Bitcoin or Ether is undervalued right now, it's really lower than it should be, like in recent days and the recent week, you'll write less calls on it, which means probably less premiums because you feel that there's a lot more upside to capture. And the opposite would be true if you feel like it's overvalued. Do I have that right?
Yeah, no, I think you explained it much better than I did. Overvalued, undervalued are much better words than overbought, oversold.
Yeah. Okay, cool. Just want to make sure we're on the same page. So yeah, it makes complete sense to me. I mean, that's, I guess why you guys have a dynamic covered call strategy. I think it makes complete sense. So the next question I have, you kind of touched on it indirectly. So for both of these funds, they're pretty much brand new. Only 2 months worth of monthly distributions were announced, but the second round were lower than the first. So I think Ether was 14 cents and then it's 10 cents. And then for the Bitcoin one, it was 10 cents and then 7.85 cents. So my question would be, doesn't higher volatility mean higher premiums? Why was there the reduction? And you kind of already touched on it already, but I'll let you answer.
No, but that's a great question because it really helps understand the underlying dynamics of what we're trying to do. So, there's a couple of different elements to it. One, you mentioned the distributions in terms of cents, but when we take a look at those distribution in terms of percentages, so how much you're earning as a percent of what the value of the underlying is, we're at very similar levels. We're at roughly 18-ish% for the Ether product. We're at roughly 14 to 15% for the Bitcoin product. So that sort of experience has been stable. Now, what a very good question from you is if volatilities are increasing, you should see the yields also increase. Why are the yields lower and then on a percentage level, on a percentage basis, stable? The way to think about this, again, goes back to how I explained our dynamic strategy. What we have done is in December, we were writing options that were roughly 15 to 20% out of the money. And we were writing, our coverage was roughly around 15 to 20% of the fund. So both those numbers between 50 and 20%. Now, as we've gone into undervalued levels on both of these, we've actually started writing options a little bit further away from the money. So there's a little less yield just because of that factor itself. And the second thing is we're writing a little bit less as well. So we're writing now in the 10 to 15% of range in terms of coverage. So those three factors combined, the valuations changing significantly over the past 45 days, writing a little bit further away from the money and writing less overall, causes that decline in yields. But we think, on a go forward basis, sort of 15% should really be very achievable for Bitcoin and, 18 to 20% achievable for Ethereum. The sort of yields that we're seeing on the underlying are much, much higher. We're just trying to do it in a much more risk adjusted manner and not really blow out some of the factor risks that might be involved in, having this exposure. So, we do think it's sustainable for at least, the foreseeable next 12 to 18 to 24 months. And, this might be getting into a next question you might have, but, as far as the sustainability of the yields goes, 3 to 5 years out, this is going to be a much more stable asset class in our opinion. So there will be less yield to have. And, in today's day and age, the yields that are available become very, very attractive. So,
Yeah.
I do think there is something special here, something that, is unique in the market. That's only being offered by purpose at the time. And, but, it's not going to be sort of these elevated levels forever.
Right. Yeah. I mean, double digit yields always get me excited, my audience excited. I mean, it's first of all, it's very hard to get double digit yields, 10+%. And like you said, even with the reduction, from month one to month two, you got to look at the NAV, and it's all according to the NAV and stock price. So like you said, it's still, 13% or whatever for Bitcoin and 18% for Ether, which is still very, very exciting for us income investors. So just, you already touched this already, both of your brochures, on your website. By the way, you have great website, great information. That article you have on the cryptocurrency is really, really good. Explains, the volatility. It compares it to at the S&P 500. So talking about yields again here, your brochure does say double digit yield. So how sustainable, or how long do you think that could be possible for these ETFs? Because, there's, in my audience, there's always some that really doubt the sustainability of such high yield. So what's your take on that?
I think it's very analytical of your audience to be thinking about the sustainability rather than just, throwing their money at it. And I do think it's a great question to answer. In my opinion, we are in a phase within the next sort of 12 to 24 months over here, where we will have sort of heightened volatility.
Yes.
Or a continuation of the heightened volatility. I don't want to say volatility is going beyond the levels it is at right now. I do think it declines as the asset class matures, but that decline is not going to be super quick. So for instance, Bitcoin at the money, near month options currently trade at around 75 to 80 implied volatility, which is how we measure how much risk is being built into a position. And it's the same thing on Ethereum, roughly trades at about 100 to 110 implied volatility. When we take a look at the S&P 500 as a whole, or the TSX 60 as a whole, those numbers are much closer to 20 to 30%. So and that's really what that's the difference between mature markets and nascent markets. So we do expect that as cryptocurrencies get more mature, get more stable, that they will move towards that level that the overall market is trading at.
Mm-hmm.
But that is going to take some time. It's not going to be overnight. It's going to take a few years until these asset classes become mature. So we think there is double-digit yield to be had in these products for the next 12 to 24 months at least, and that's on a conservative basis.
That's awesome. That's great. And I mean, even if the yields start decreasing, you're still, my audience needs to understand that these are ETFs that hold Bitcoin, right?
Mm-hmm.
That hold Ether. So there's a lot of growth potential. So there might be a lot of yield now, a lot of volatility, but always keep in mind that even though my channel is really about income, there is a lot of growth potential as well with the underlying cryptocurrencies, right? So it's a balance, right? It's a balance, like you said. So okay, so for both of these ETFs, you have a hedge, you have a non-hedged version, and you also have a US currency version. So some of my audience members, they always want me to ask this: are there any plans for purpose to create a US listing of these funds, like a listing on the New York Stock Exchange or the NASDAQ that Americans can access, or people who invest on the US stock market, not on the Canadian stock market?
Yeah. So, we never say never, but as of right now, we don't have any exposure to US exchanges for purpose as a firm. And, I wouldn't be able to share with you if there were any plans to go into the US either. There's a whole bunch of regulation and compliance around that.
Yeah.
So what I will say is, we are always looking to service investors that are interested in unique solutions and goals-oriented solutions. And we'll try our utmost best to get access out there for investors that need access. And as of right now, there are US brokerages that will allow access to Canadian exchanges.
Yeah.
And that's why we have the US dollar product as well, the US dollar denominated product as well, is that so when international investors come and take a look at such a product, that they have an easy in, and they don't have to worry about the currency that goes on.
Yeah. Yeah, I mention this to my audience all the time. Most of them are Canadian, but I do have a growing audience base in the US. And, a very common question I get is, I can't find any of these stock symbols. What's the problem? Well, I tell them, well, these are Canadian listed funds. They're listed on the Canadian stock market. So you got to make sure, like you mentioned, to have a broker that could invest on the Canadian stock market. And there's plenty of them out there, especially the big ones. I don't know them by heart. I know the Canadian brokers. I don't know the American brokers, but I think if they do a little research, I'm sure they could find a way to invest in these. And like you said, there's a US currency one. So you invest in that one, it's all US currency. There's no exchanges or anything like that. So thanks for that answer. I really appreciate it. Now, in terms of other yield-focused ETFs with double-digit yields, my channel, we're all about passive income. Does Purpose have any plans for maybe an all-in-one covered call leveraged fund, which seem to be getting more and more popular? You have a HDIV from Hamilton ETFs that came out about 6 months ago. You have a new one called HDIF, which was recently announced by Harvest, which they're kind of like combining several covered call ETFs or several covered call strategies and putting leverage on it. Any plans for any type of future product like that at Purpose?
Yeah, so the leveraged income products have been gaining a lot of popularity in Canada. That mostly comes because we are again in a mode where it's a hunt for yield. That's sort of going on, right? Like the rates have been low for a very, very long time, and now, as we can clearly see, there's more rate hikes coming. There's a lot of allocational switches from fixed income to equities, while still sort of trying to maintain that income oriented allocation. So we're seeing a rise in popularity. It's definitely something we're keeping an eye on. And I'm not free to comment, but I would definitely ask viewers to keep an eye out for Purpose investments in this sort of space. We have the expertise that's required on the covered call side. We have the expertise that's required on the regulatory side to launch products that are risk adjusted, are goals oriented, and do meet the requirements of today's modern investors. So hopefully within the next few months, you'll sort of have a few more options on how to get a little bit more passive income out of your portfolio.
Oh, I like that. That sounds like good news to me. And I'm always on the lookout for new funds. And sometimes my audience members catch it before me. Like I said, we have a Facebook group, and right away, as soon as it's a prospectus is released, someone already puts it in the group. So yeah, that's what we love. And it's, looking forward definitely to some more Purpose investments options that way. So almost finished. Just a couple of general questions for you. I always like to ask the professionals these last two questions. Covered call strategies in general, do you feel that they're getting more and more popular these days?
So covered call strategies have been around for a while, right? And if we think about derivative strategies, in terms of derivative strategies, they're fairly plain vanilla strategies. There's nothing overly complex. I think people really understand the exposures that they have. So there's more and more investors that are getting comfortable with, how long these strategies have been around, what their track records look like, how they act in different periods, under different scenarios. So there is definitely, an increased amount of comfort with these strategies. What I'll also allude back to is where we talked about allocational switches from fixed income to equities. So there is definitely that hunt for yield is sort of back on as we see investors, with sort of passive income portfolios start looking for places that they can, maintain that 5+% yield that sort of like people have in the back of their heads, which is becoming more and more difficult in current environment as dividend yields sort of get squeezed with this huge capital gains that we've had over the past 2 years. So, there definitely is an increase in comfort with covered call strategies. And I do think in the near future, and I think we're seeing this already actually, but I think in the near future, you'll start seeing a lot more of your equity allocation become more income oriented, but income oriented with downside protection. So, combining those two elements, which is essentially like a synthetic bond, is going to become pretty important in investor portfolios for the next 2 years.
Yeah. Would you say, just question like that, would you say a covered call strategy, this is, I always say it to my audience on my channel, it's really a defensive equity strategy, right? Because those covered calls literally assures you some income and some protection when volatility hits. Anything covered call tends to outperform during strong periods of volatility. Would you say that covered call strategy is kind of a defensive equity strategy?
So yes, I agree with the defensive part, but I think it's important to understand when covered call strategies outperform. Generally speaking, your covered call strategies will outperform in a sideways market, and it has the potential to outperform in a downside market as well, because you're pocketing a little bit of an extra yield, in addition to the equity exposure that you have. In where it underperforms is in a market that shoots upwards.
Yeah.
So when you have a rally going on, you'll get called out of these names. You might not be able to get the full potential of an upside rally in some of these, of the underlying. So, I'll just add a little caveat to that. I think it's very important to understand where the moneyness of the underlying options is. And that's what will help you define how much of a rally you're going to participate in any point in time.
Right.
So, with the simple banks, for instance, there's a lot of banks covered calls or financials covered calls out there. They typically tend to ride just outside of the money. So any sort of rally that we've seen, even, the banks rally that we've seen of the past 4 weeks in Canadian banks, the covered call strategies will tend to underperform. But in periods of, slow growth, in periods of sideways markets or downside markets, covered call strategies should outperform.
Perfect. Thanks for that. I appreciate it. And the last question I have, I love asking this question. So on my channel, I typically say that, covered call income, which basically, if you think about it, is based on options trading, which is kind of like stock trading. It's always there. It's always active. It's, I say to my audience, think of it like an infinite and a very consistent source of income. So in your opinion, I got to ask the professionals here. I love asking the professionals this question. Do you feel that this options or derivative income from covered calls is infinite? Do you think that there's going to be a long time covered calls, or as well as puts, I guess, options are always, and premiums are always going to be had, and is that going to be a consistent source of income for a really, really long time, if not infinite?
So yes, I agree with you. I don't think it's a question we think about often, whether it's infinite, just because infinite seems like such a large concept to get your head around. But as long as our market structures remain resilient, then yes, there is the possibility of always being able to have that yield available through option structures. But what's more important to take a look at maybe is the stability of those option structures, or the stability of that yield. I do believe, there are many different market factors that can change the stability of that yield, or cause, and the other way to put it is cause volatility within that yield. And that's something to be much more careful of. But the regulatory structures that are in place right now do call for, infinite income to be available. And unless we see some sort of a massive change on the regulatory structure, such as, limitations put into the options market for who can participate and who can't, then there could be hiccups. But given the structure that we have, which hasn't really changed in any significant manner in the past 30 years, it does seem like we could be in an infinite income scenario, in terms of how long this goes on for, when it comes to covered calls.
I love that. I love music to my ears, honestly, because covered calls is really my strategy's bread and butter. I'm a buy and hold passive investor. I just buy and I hold, and I collect the premiums and the dividend income combined every single month. So I really love that. Thanks for answering the question. Really appreciate it. Thanks for answering all the questions, by the way. They were very precise, very enlightening. I always like talking to a professional portfolio manager about this stuff. So thanks again, and hopefully you'll come on again soon. If ever you guys create a new product, especially one that's yield oriented, feel free. I always like to cover those products and give my audience the news on them as they're created. So thanks again for coming on. So I'll let you put in a last word or anything you wish to add before we wrap up. Go ahead.
No, for me, it's just going to be, thank you for having me on. And then secondly, I really do appreciate the sort of view that you're offering retail investors, through this content creation that you're doing on YouTube. I do think it's, it's really the future of education. And I'm very happy with the sort of questions you asked, how sort of well-informed as well as inquisitive those questions were. And I'm just happy I can help along, you along in your journey, as well as your audience along in their journey and making better decisions along the subject of passive investments and really harvesting yields. So this has been a very interesting sort of take at it. And thank you for having us. And hopefully, in the near future, we'll get to chat again.
For sure. Thanks a lot. We'll keep in touch. And of course, one last thing, thank you for creating these amazing crypto yield ETFs, first of its kind. Really appreciated double-digit yields. I know my audience members are ecstatic about these because of, we hunt yield. So a big thanks to you and your team for actually creating them. And hopefully we'll talk again soon. So thanks a lot. Right. Take care.
Thank you.
Thanks for watching, everyone. I hope you enjoyed that fund manager interview. I have a lot more coming up in the future, so make sure to stay tuned. Please show your appreciation. Hit that like button, hit that thumbs up button. I would really appreciate it. It takes 2 seconds and it helps the channel grow. So it's a win-win. Also, since I have a lot more great content, including fund manager interviews coming up, make sure you're subscribed to my channel if not already done, and hit that little bell next to the subscribe button so you're notified when a new video comes out. You don't want to miss it. And don't forget to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. You only have to buy it once because it comes with lifetime updates. Don't forget that. So this product is really a reference tool, a companion tool to really help you build your own portfolio according to your investing goals and needs. And it's good for Canadians and Americans as well. You have sample portfolios for both the Canadian stock market, the American stock market. And my intention is really to do at least at the bare bone minimum an annual update. So make sure you to pick it up because it comes with lifetime updates. Also on my website, right there on the homepage, I do offer a one-on-one consultation service with me personally. It's a 1-hour Zoom call. In case you want more personalized help here, you could ask me all the questions you want. You could, I'll help you, I'll analyze the situation, help you build a brand new portfolio, help you transition to an income-focused portfolio, analyze your portfolio according to your needs. Whatever you want me to do, whatever help you need, I am there to help you. I absolutely love meeting people all around the world and doing these one-on-one sessions, but I gotta limit myself to 4 a week because I need the time to create obviously more YouTube content. So I know they sell out very, very quickly. I get emails all the time from you guys saying, can you put me in? Can you put me in? I always miss the appointment. I apologize for that. There is a high demand for the one-on-one consultation. So like I said, I got to limit myself to 4 a week, but make sure you're subscribed and make sure to join our Facebook group because I make the announcement whenever the calendar becomes available or the new appointments open via YouTube, community post, and via Facebook. So join our Facebook group, Passive Income Investing. We have a nice Facebook group, almost 10,000 members. It's a nice group where everyone just puts their questions and we all try to help each other out. You could put your portfolio to get opinions. So don't be shy. Join our Facebook group and join us there to really share in the knowledge sharing, right? It's a great group. We're also on Instagram. If ever you want to know more about our personal day-to-day life, you could follow us on that social media platform if you use it. My mission, the mission of this channel will always be the same. It's to help everyday, normal, regular people to invest on their own, to build their own stream of passive income, to enhance their quality of life, and one day become financially independent. There's no greater feeling in the world than financial independence. Trust me. So continue to stay safe, everyone. Stay healthy. And of course, stay passive. See you next time.